Well, good morning, everyone. I'm Dan Smereck from Strategic Asset Alliance, and I'd like to thank you for taking some time today to talk about trustees' roles in investments and their obligations and duties and things to consider and perhaps avoid that we've learned from our tenure in working in the pooling industry going back to 2014. We appreciate AGRIP and also my partner in crime here when we presented this live at the AGRIP meeting in March. Tito Villegas won't be joining me, but I have a handful of his slides in a live case study to give you real perspective about what went on when we actually made a change and had to re-educate trustees as their investment parameters changed. And with that, what are a trustee's investment responsibilities? Some of this stuff can be pretty dry and put you to sleep. So my goal here today is to really leave you with some key takeaways on how perhaps you should consider some additional ways to think and or questions that you may pose to your staff, as well as your investment managers, whether they're external or internal. So trustees, you have a number of duties to fulfill across the organization, and this is but one of them, but it's a large one, as when you think about the largest investment that a pool has after its people is the investment portfolio that sits in between collecting contributions from its members until you pay the claims on the benefit of your members for the programs that you share with them. And so three top things that come to mind: what your role is to act with reasonable skill and care. That's going to be dependent upon your individual experience and knowledge base. We have a lot of firms we work with that don't necessarily have really any investment professionals on the board, or just backgrounds in institutional investing. And that's neither bad nor good, but knowing the limitations and how you may think about that is certainly advantageous to trustees as they evolve and they learn the business. It's particularly applicable to newer trustees. Take advice where appropriate. Now, the world's full of those of us out here that like to give advice, but the purpose of that is how do we help support all the other things that you're trying to do? And for those of us that are immersed in the investment markets all day long, how can we best help you in thinking about the investment markets and how they can be used to fulfill and propel the enterprise goals and objectives of your pool? And also to keep investments under review. We found over the years that there are a number of times where investments are looked at once a year, or they're kind of looked at briefly as an agenda item in a broader committee for audit or finance. Again, we're mindful of our self-interest here, but investments are, to my point earlier, a significant investment for the pool as that money sits to support everyone. And so how do you do that in a more timely manner? Not once a year, we typically see it quarterly, et cetera. So those are some of the things on how you think about to best position yourself to ask questions of the people who are actually providing the operational skill and or the tactical and strategic advice for the investment portfolios. So responsibilities continue. Key elements here in your decision-making process, are important. So one is, suitability. Well, what does that mean? What is the pool trying to accomplish? What are the appropriate asset classes? Some of the pools in this country are completely limited on what they can invest in. Other ones can invest in nearly anything as long as it's considered prudent and there's justification as to why that may be incorporated in their program. And usually pools fall somewhere in between there. It typically deals with how comfortable investment committees or finance committees and staff are with various asset classes. Wall Street has acronyms for everything. Like any particular profession, but they love to wrap themselves in it for reasons that are still unknown to me. So how do you get comfortable with asset classes? By asking questions, et cetera, that could be very helpful to a pool, but oftentimes are misunderstood or misrepresented. And once it's clarified, you realize that actually there's some interesting things out there that can be used. Diversification, probably the biggest issue that crops up is being diversified in the portfolio, particularly for risk pools that can invest in other asset classes besides bonds or treasuries. We think about the most conservative treasuries, agencies, agency-backed mortgage securities. Then we move into corporate bonds. Then you get more aggressive and riskier assets, as we call them, equities, both domestic and international, high yield bonds, et cetera. But all those play a role in diversification. And that truly is the only quote unquote free lunch out there when we think about portfolios. And lastly is the delegation, typically by trustees and boards, is the delegation of the investment management responsibility, but that does not mean abdication and allowing the third party to basically become the sole provider of those services and dictate some of the changes, whether they're tactical or strategic. This is something that is truly governed by the board and the committees, and the folks you bring on board are designed to support that based on the investment policies and guidance that you provide them. So investment process is key. We think about this, trustees, I have two key words here: understand and be comfortable with their risk pool's investment process. And that's, I'm not going to read this to you straight out, but this is a very good quote here to think about. Understand and be comfortable with what's going on in the investment process and being not afraid to ask questions. So what is the investment process? Every advisory firm or investment manager firm has a process, and it's important to get comfortable with that process, regardless of your provider, because it gives you a window into how they're thinking, and then how they take that thinking and turn it into action, which then translates into how your portfolio is constructed. And so what we fondly call at our firm on the left here is the wheel of fortune. And so it's the investment process value chain in the middle. I know it's a very clever name, but if we go to the top and you see the most important decision that a committee board can make is the allocation decision. It's going to derive 95+% of your future returns on how you're allocating the money in the pool based on the types of programs you're offering. That's going to generate those returns. If we move clockwise to the right, then you're going to bump into policy. So investment policy is designed to reflect the comfort level, so the risks, the constraints, the allowable asset classes, et cetera, in a policy document that is easy to understand, easy to read, and more importantly, easy for an investment manager, for someone to codify, particularly in an information control system like a compliance system, to ensure that your allocation decisions are met, but without having trades that would violate those. So policy, of course, is a key document, but it flows from the allocation decisions that you make. Oftentimes we see policies done before an allocation analysis is done. And in our view, that's backwards. You need to think about allocation, what's allowable, what's suitable, and then have the policy reflect that, so the people you delegate to are able to have a blueprint on how they need to implement those decisions on behalf of your organization. So then I have implementation is the next one. How they buy bonds, how they construct the portfolio, how they support your operational needs for cash, all those other things. How do we follow implementation? Very important. Then we monitor that. It's a feedback loop. How do we monitor their portfolio? Various types of reporting is available out there to provide trustees a very good perspective on how the portfolios are being managed, how they're evolving over time, and how they're responding to the current environment, like what we're dealing with today, which I'll touch on briefly. As we're moving along in the 8 o'clock range is measure. Measuring performance is key, and not just manager, well, how did we do against a benchmark? Typically, we see that when we get invited to talk to folks, and then there are other ways to look at performance. Risk adjusted, how much risk is the manager taking relative to the returns they're generating? How does the return of the portfolio jive with what you're trying to do from a budgetary standpoint? There are lots of different ways to measure and look at performance that I'd say the typical, which is just looking at the manager's returns relative to a benchmark. And then peers are important anywhere. They give you perspective. They shouldn't be a reason to say I'm a significant outlier, but if you are, that usually provides pause to say, well, why would we be that way? And so peer groups, for instance, working with a number of risk pools around the country, we have our own peer group with investment portfolios, which is useful for us to educate, the keyword educate, our other pool clients and other folks just in the pooling community about how their portfolio looks relative to some of the other peers across the country. And you put all this together, and that's a good overview, in our opinion, for any trustee to get a handle on these points along this wheel that allow them to not only begin to understand how things flow through the investment program, but most importantly, feeling comfortable to ask more questions of those they've those that they've delegated the authority to execute and implement these plans. So with that, kind of setting the stage there, is we wanted to talk about some of the errors that we've typically seen working in the pool business now, going back to 2004. So I'm rolling on 18 years here. After you get hit in the head a few times, you start to see certain patterns, or at least you hope you will. And that's going to raise a couple key things for you to take away here. Is the typical errors. And there's errors everywhere, we all make them. It's how you recover from them. But there are some errors that, in our view, should just be avoided up front. And so there are three key ones here. One is not considering all allowable asset classes to have a more diverse portfolio. I touched on that a little bit earlier, but we've often run into pools that say, well, we're comfortable investing in treasuries agencies. We can invest in some other asset classes. Our investment manager, folks may say, well, we don't really think that's prudent right now. Our view is you need to look at all asset classes that are allowable. And if you have an investment firm that doesn't have the capacity or the resources to look at all of those asset classes, then you may need to consider other options so you get a better perspective on what's out there, given what might be available to you. The other one is not reviewing the pool's overall investment process on a periodic basis. I can't tell you how many pools I've run into over the years saying, well, we've had the same investment manager for the last 25 years or 20 years, and we get an annual report and this is how it goes. In our view, that couldn't be further from how you should look at things, just given things evolve, things change. One shot managing for 20, 25 years, looking at fee levels. There's so many things. We end up doing a lot of fiduciary searches for folks that basically keep everybody honest, as well as, again, educate committee members, trustee members on what else is out there, just to see in fulfilling, fiduciary obligations, which, our firm, we take, and so many others, take very seriously. And that ties into not consistently reviewing the investment manager, as I say, and just seeing what's changed there. You have the 4 Ps, as we call it, for investment management. You have people, philosophy, process, and performance. And you put all those together, and those can change rapidly if there's key departures, particularly at smaller firms. We're a smaller firm, we're keenly aware of that. So those are the types of things that are the typical errors, and these things can be addressed very straightforwardly in our view to help clean up some of those items that make for a better process. The one that I would say another potential error, and I highlight this because over the years I've often got lots of questions from folks, on board members in particular. They're not really related to the institution or the organization. They're definitely personal investment questions cloaked under asking under the trustees or from the pool perspective. Now, I don't say that negatively. I say that more interesting in that. So one of the things is that investing in pools and institutions is not personal investing. There are some tremendous differences. Some of these are going to be obvious to you out there, but it's remarkable how this gets conflated when I have discussions with folks, or we have discussions with folks about diversification, allocations, those types of things. And so 3 things come to mind. We have personal investment portfolios differ greatly from risk pools. We have time horizon differences, constraints, tax situations. There isn't a tax situation for pools. That's a great asset for pools, given what we could do in various asset classes if they're available. Number 2, our risk pool practices dramatically differ from endowments and pension funds. We've had a number of trustees over the years that have experience in those areas or sit on boards and committees in their states, et cetera, on those, very different organizations. And then lastly is, enterprise risk management should be a consideration. Well, for those of you that aren't familiar with that, enterprise risk management is the integration of financial modeling, of tying in the liability profile, and so your actuaries and your underwriters and their expectations with the investment portfolio and the investment markets, and put those 2 together. And how does that help generate? And it's a tool, because those that know me, I say, and it's not attributable to me, it goes way back to the 30s, to an old British statistician, is all models are wrong and some are useful. And so enterprise risk management is a tool, a model that allows staff, committee members, trustees to get a little bit better perspective and framework into how the investment portfolio fits into supporting everything. And so again, these 3 things I would implore you to take away with you when you think about the investment program. So let's talk about assets and diversification to give you a quick snapshot. This is looking at risk and return, and this is a very familiar exhibit across the investment environment, whether you're personal or institutional. And on the vertical axis is looking at the total return of the respective asset classes on this grid in geometric shapes over the last 15 years. And so these are annualized returns. So at any point along that vertical axis, you see a number that's representing a return. For instance, I'll go to the top line, easy to see, 12%. That's 12% annualized over the last 15 years. On the horizontal axis is a widely used metric to show risk or volatility, more apt. And that is just how volatile the returns were. So the more volatile the returns are, meaning that you may have some ups and downs more readily than you are in asset classes that have lower standard deviation or volatility. And as you can see, this chart is pretty much finance class textbook for the last 15 years, except for a couple dots going from left to right. You'll notice cash has the lowest return and the lowest volatility by definition. The next delightful four-pronged star shapes here are fixed income assets. And you can see the aggregate bond market represents the investment grade bond market that includes treasuries, agencies, corporate bonds, US mortgages, et cetera. You have corporate fixed income, bank loans, high yield fixed income. But what you see is a pattern going up and to the right until you see the circles on the right and the top, which are the equity markets. And then you have developed or international equities down and a little bit to the right. It has not been a good time for international equity markets over the last 15 years. But I share this and just spend a little time, this is the diversification issue. This is the free lunch aspect. So if you're a risk pool and you have the ability, and there's some that have the ability or had the capability to invest in equities, for instance, but did not, you can see the dramatic drag on investment returns that they would have had because they didn't elect to pursue that for whatever the reasons might be. And so this just sets things up for where we are today. A little, let's bring us up to what's happening today. This exhibit is a drawdown exhibit. And for those of you that don't have the joy of seeing these types of exhibits, this is looking at the market. In this case, this is the Barclays capital aggregate market. So this is the aggregate bond market in the US. And so this is the biggest market where the risk pools invest the majority of their money. And so what this is looking at is when the returns in this market were negative, showing on this graph, how sharply negative were they? And then how long did it take them to come back to zero and then go positive again? And so as this goes from left to right, you're going to see some pretty ugly lines starting out in the late 1970s. So we're talking 40 plus years ago when we saw the Carter-Reagan administration transition, and when Chairman Paul Volcker of the Federal Reserve, now Chairman Powell, his counterpart 40 plus years ago, had to raise rates sharply to quash inflation that was much higher than it was today. And so you put that into perspective and you follow that red line on this exhibit. We have to go back 40 plus years to experience what the bond market has experienced this year. So all the way to the right is showing you since August of 2020, the bond market has been on a downward net negative trajectory, bringing us to the end of April, being down almost a little over 11% since August of 2020. Now, this is remarkable in the sense that most people aren't used to seeing bonds, particularly treasuries, agencies, corporate bonds, equities, all go negative together like they did in Q1 and through April. Things have changed a little bit through May. But I wanted to share this with you because this is what trustees have to deal with. When you have an event like this, what does this mean for your advisors? The managers come in and tell you what their views are. And you think back to this, we haven't experienced this for 40 plus years. And so a little social tidbit here, as I was talking with Steph before this recording started, is the majority of the people on Wall Street that are trading your dollars these days, typically it's in the late 30s, early 40s. Most of them weren't born or were toddling around in the 70s. And that's neither good nor bad. It's just interesting to provide perspective as to what type of historical context do some of the folks on the street have to the inflation levels that we have today? And the answer is most of them do not. So that brings me to the big takeaway here when we think about assets and what it means. And this is a great example of the time horizon comment I made earlier about personal investment versus institutional investment. So what this exhibit does is it looks at the annual calendar year returns post-World War II from 1950 to 2021, and it breaks them into periods going from left to right. So on the horizontal axes is the time periods, 1 year rolling periods, so 1 year calendar periods, then 5 year rolling periods, 10 year rolling periods, and 20 year rolling periods from left to right. The vertical axis is showing you the total return. So you'll notice when you start going from left to right, and you notice the first section of bars, is they're significantly taller and lower than the bars to the right. Well, this is showing you how volatile asset classes can be on an annual basis. And so the green is stocks, the blue is bonds, and the gray is a 50-50 split. And so why this is important is for filing for financial statements on an annual basis. This is how ugly your financial statements can get from an investment point of view. So the worst performance of equities, to use the sharpest contrast here, on the bars all the way to the left, was down 39% in the worst trailing year period. It was up 47% is the best performance. Well, that translates to 08 and 09. What happened in the Great Recession when we saw the shock and then the recovery. So that's the worst, that's the highest up and the lowest down since the Great Depression. You'll then notice, however, you see the equity portion being down 39% in the worst year. But when you look forward and take that same equity portfolio or any portfolio exhibited here, and you start looking at on a 5-year rolling basis, or a 10-year rolling basis, or a 20-year rolling basis, thinking about the time horizon of the risk pool, you'll notice that the downside of the portfolio is diminished dramatically. And so it's somewhat obvious, but when you see it this way, it helps make the context of the boxes all the way on the left. And we have an ugly year or an ugly period like we're doing right now. When you look forward 5 years, despite what we've experienced now, and think of all the awful periods, market performance we've had going back to 1950, it gives you some context about being consistent, being patient with how the portfolio is going to respond over a longer period of time. Now, if your business changes during this period of time, that mixes things up. But if your business is moving along with the coverages that you provide, et cetera, to your members, then the investment portfolio historically naturally comes back over a longer period of time. And that's, again, just providing caution and tying back to your investment policy and how you look at allocations and targets to provide you that guidepost when you have volatility in the markets. This provides you with, again, context to weather those storms when you think about things over a longer time horizon. The other thing that comes up is this term fiduciary. Utilize a true fiduciary. And we harp on this at our firm because oftentimes your investment folks may not be fiduciaries. And again, that's not necessarily good or bad. It's just, it provides, again, context. And so what is a fiduciary? You know, in English, it's someone who is beholden to take your interest first. And it's typically documented, it's stated, et cetera, when investment decisions are being made on your behalf. That's the narrow view. You know, we're talking about investments today, as opposed to fiduciary overall is someone who's looking out for your best interest before their own, given the services they're providing to you. And so just because someone is managing money, you know, are they a fiduciary or not? And so we have some things here, some highlights of just saying some questions you can ask to confirm that who's ever managing your money is a fiduciary, which we recommend. So are they registered for an investment advisor with the SEC? Like our firm and so many other registered investment advisors, then yes, we're a fiduciary by definition in the context of the SEC registration that we have. Are they a broker dealer who's responsible for investing assets? We see that a lot, particularly in smaller pools. Technically, no, they're not fiduciaries unless they provide you some alternative statement that they're a fiduciary. Again, not to alarm, but just to provide context as to what that means as a trustee when someone asks you from some other stakeholder or someone in government, say, hey, well, do you have a fiduciary running your money? And you don't have an answer for that. You know, are they internal? That doesn't mean they're fiduciary either. How does that get dealt with? If you're unsure, you ask them, and you have people provide you assurances in writing. We've done this over a number of years, and it still is remarkable how many folks out there, particularly on the broker-dealer side, managing money are not technically fiduciaries. Granted, that's a perspective we have and an appreciation we have, and we like to pass that on to all of you. So let's talk briefly about a live case study. And my partner in crime presented live at the AGRA conference was Tito Villegas, the chief CFO and the chief investment officer at the Texas Municipal League Intergovernment Risk Pool. We finally called them TML-IRP. And this has to do with something that evolved very quickly going back to the summer of 19. And so to set the stage, and even though the numbers are large on this, just given the size of the Texas pool and the size of the state, the numbers, the process would be absolutely applicable to any pool of any size. And so you can see here the portfolio, 18 board members or trustees. In July 19, I would say a miraculous event is that the legislature said, hey, we're going to give you these presumptive coverages. You're all dealing with that, I know, across the United States. but we're also going to give you expanded investment authority. It was lobbied and say, well, if you're going to presume these to us and we have to cover them, you got to give us a means to fund these long tail liabilities. These liabilities are going to be on our books for 30, even 40 years. And so they agreed to that with effectively no major constraints except to say you need to use the prudent person rule, which can be construed many different ways, but back to that fiduciary comment that I just made. So with that in the summer of 19, so we started in October of 19, and SAA was starting then to work with TMIRP is how do we educate and familiarize the board with these expanded investment options? All of a sudden they could diversify. Before this event, they could only invest in treasuries, agencies, and high quality taxable municipal bonds and US agency mortgage fixed income instruments. All of a sudden they could invest in anything under the prudent person rule. So keeping that in mind and not wanting to go, as my grandmother would say, hog wild over what type of investments we could go, we wanted to see what would be a prudent evolution to adding this to fund those presumptive coverage issues. And we educated the board in a series of steps over a series of 3 board meetings to talk about the process of other pools, the prudent person flexibility, and how we can implement this. So January of 20, we developed and reviewed and approved the plan with the board after these educational sessions. And then in February, we started to February of 20, interesting time to start investing in equities and other assets just as COVID was coming online. But we had a process for that, averaging into these exposures. And so when COVID did hit, it was a shock, of course, but it didn't change how we progressed. It changed the pace of how we progressed, but it didn't change how we were progressing because it was a strategic decision, again, over a much longer time horizon than what the market was giving us in March of 20 and early April of 20. So before and after. So what you see here, and again, it's going to look a little different because of the market conditions today, is the portfolio over the left is showing you how it looked at the end of their fiscal year, September 30 and 19. And looking at the colors on the bottom left of this exhibit, you can see US mortgages, muni bonds, cash, and some US Treasury, a very limited conservative portfolio. In the matter of just 2 years, if you look, 21% of the portfolio on the right migrated to higher risk, higher return investments across stocks, high yield corporate bonds, and investment grade corporate bonds. A very dramatic shift, but it was in line with a strategy that was looking out over a much longer time frame. And again, tying that all into providing comfort and understanding to the board that allowed them to make this decision and be comfortable with it, looking at the ups and downs and the expectations of this going forward. So how this translated financially, again, through the 12 months ending September 30 of last year, of 21, and there's a lot of numbers on this page, but I want to highlight the unrealized gain loss portion. And that is showing you the government portfolio was actually down because of interest rates rising, had a $13.8 million unrealized loss. The long-term benefits portfolio, as we call it, that new portfolio, that 21% with equities, high yield bonds, and corporate bonds, was up 11 million. So it helped offset, and again, just providing, once again, evidence of diversification that helped stabilize their financials as the markets were moving in 2 very different directions back in 21. This relates to performance. So this is one way to measure. So we have total rate of return for this 1 year period. The consolidated portfolio was up 2.3%. It was positive. But their bond portfolio, that $500+ million, was at 0 for the year. And the long-term benefits program was up 11%. Those are the types of things, again, from an education standpoint, thinking about this. Over a longer period of time, we would still expect this portfolio to outperform than just being invested in bonds. So key considerations and next steps. My last slide for you all, and the cheering can begin, is there's so many things, but I wanted to leave you with these. So understand any regulatory constraints on allowable asset classes. Some of you don't have any regulatory constraints. You may have your own constraints. I've seen pools that have legal opinions that tie them to certain things that have nothing to do with the regulatory environment. So being mindful of what you can invest in, and if it's allowable, we believe you should get educated and take a look at it and how it might fit into the program, because it's just another tool to support your members. Another one, number 2, is key, is determining the risk pool's appetite, the risk appetite. We've done this via questionnaire with trustees and board members over the years. Also, you can do it with scenario-based analysis, back to modeling, enterprise risk. How do you look at different allocations based on what's allowable and put that in and see what type of upside and downside comes out of that in context, and not just from one person or one firm, but how do your actuaries think about that? How do your underwriters think about that? How does your finance department think about that? And how does that tailor? The most typical thing we see is that risk pools financial positions can often support a more diversified portfolio than what investment committees and or boards may be comfortable with. That's not a negative. That's just showing you a little bit of the disconnect there between how trustees and board members pursue their role or view their role in investments as opposed to what the financials may say they can support. Just something to keep in mind, particularly when you're thinking about modeling work. Number three, think institutional, not personal. Everybody has to bring their personal experience with them when they come into a situation like this. But back to my comments about institutional, your horizon is much longer. The portfolio's role is very different in how it supports all the other things you're trying to do for the benefit of the members. Implement an ongoing investment education and re-education process. Absolutely key. The markets are alive. They change all the time. You know, Bitcoin, we got all kinds of questions about that. I won't torture you with that today. It just tells you got to have an ongoing educational process from the people that you trust, that you hire, that you delegate to. And then, you know, we always review at least annually your current asset allocation and think about potential alternatives, whether it's changes in the parameters you have or allocations. And those are just the top 5 things that I came up with today to share with you. And that concludes what I had to share with you today. And I appreciate your time. And I'd be happy to, in the future, address any of these issues with you. And have a good day.